Hi, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin, your host. Well, we're looking at the chart of the S&P 500, which is where we start usually. And let's zoom in a little bit. Use our annotation tool. You can see we had kind of a doji week where there was a little indecision in the market. We closed, I think, slightly higher for the week, but not much. So the market ran up, or actually at first it ran down, and then ran all the way up, and then pulled back into the close of the week. So I've got this box drawn on here, which is the pivot above here. So, like usual, the market is being cryptic about what it is trying to do. But the odds are, so we're still talking about odds here. The odds are this is still some sort of 2, A, B, C, where this is 1, and we're waiting for 3 to happen. Now, it's possible it could, go ahead and make new highs and maybe come up into this area. But the problem is all the internals, as it's gone up like this, have gotten weaker and weaker, which does not portend, in this case, a wave 3. So, in other words, if this is the low, and this is wave 1 up and pull back, and then wave 3, the type of internal action we have here, advanced declines and breadth and things like that, are not indicative of a new bull market. So that doesn't mean that it couldn't be that way. It's just that it's a very weak uptrend. In fact, this week right here, there was a couple of days in this week that were up pretty big. I think we gapped up and ran up, and actually it was one of the weakest days in this whole trend here. So not indicative of a bull market, and but pretty indicative of a wave 2. A lot of times, wave 2, whatever people are feeling right here, is very similar to what they were feeling right here. So the characteristics portend an ABC with a 3 coming. I would give that about a 70% chance. It doesn't mean we couldn't go a little higher here. I mean, this coming week, we could actually come up here and make new highs above this old high right here into this area. But it's not going to last long, and it could actually be over. So a lot of times markets will top on good news, and if you'll recall, we had Trump doing the thing with North Korea. Of course, there was some bad news in there too, like the trade, some of the trade stuff, the tariffs, and all that stuff. But the news really is not something that's very tradable, so I wouldn't focus too much on that. But it does tend to be true that markets top on good news. So, all right, let's look at the volatility index. Volatility continues to come in. Very, very low volatility numbers historically, and in this trend, they're very low. So closed, I think this is the lowest close we've had since way back here in January. So could be portending something big. We'll see. The VIX, really what you just do with the VIX is you look to see that it's confirming that there's not some sort of divergence. And it doesn't appear to be a divergence because the market was basically up a little bit and the VIX was down. That's what you would expect if the market was up. All right, here's the 10-year Treasury. It's pulled back, ran up. It's pulled back a little bit this past week. Might pull back a little bit more, but probably going to run up if we see some sort of market sell-off. So there's a tendency for money to flood into treasuries when equities sell off. So that's what you could see. All right, well, let's look at the 13-week yield. That's the one that tells us what the Fed's going to do. And you can see that more or less, we're still following this trend that I drew, I don't know, somewhere way back here. But, it's kind of flattened out right here. Now it's starting to curl up. You can see it's kind of flat right here, and then now it's kind of starting to curl up a little bit. So I would expect this to continue. Even with the 10-year pulling back, this didn't pull back much at all. So, which is pretty normal behavior with respect to the 10-year. All right, let's look at some of the other countries. As you know, my feeling is I agree with Proctor, and I think it's going to be a global event. And these other markets, this is Germany, actually look weaker than the United States. So some of that is that emerging market negative news with the strengthening of the dollar. You've had some of this. The reason that happens is a lot of these emerging markets have to borrow money in dollars. So when the dollar strengthens, that means they have to pay back loans in dollars. So they're, it's crippling to their business. So not only it's kind of a double whammy because their currency goes down and they have to pay back loans in dollars. So it's a pretty tough time for emerging markets. Now, there's all kinds of theories on that this is just temporary and so on and so forth. But I think we've shown in here that the dollar is probably, made the big trend turn, and it's going to start going higher. That doesn't mean the dollar couldn't pull back some. The dollar could actually pull back quite a bit, and we'll look at it here in a second and take a look at that. Here's the United Kingdom. It actually looks stronger, but then recently, in recent weeks, it's kind of rolled over and looks like maybe it wants to head lower. The really strong markets have been the NASDAQ and the Russell. So you can see the Russell here is just going up and up, and this looks like some sort of wave 5, or this could be A, B, C, which would be strange. I don't know. This looks weird to me, but it's unusual for the Russell. If we think the market's going lower, it would be unusual for the Russell to actually be, a leader in that. It seems like it'd be more likely that the Russell would lead lower instead of leading up. All right, let's look at let's go to regular charts. So here's kind of the count we've got since the February 2016 low. We kind of got 1, 2, 3, 4. You see, 4 is pretty shallow. That's why, there's a possibility this is 4 because this is more proportional to this 1 here, and this 4 is pretty narrow. So it's possible this is a 4, but the breadth and all that stuff in this most recent last 4 months run up has been really, really weak. So it's hard to really bite off on that too much. All right, let's look at the euro US dollar since we were talking about the dollar. You see the euro's been selling off and rallied a little bit. Now I guess this is some sort of wave 5 where this is 1, 2, 3, 4, 5. But then we're going to have a pretty good rally in the euro, which means the dollar is going to sell off quite a bit. So, and maybe the euro rises to up here around 120. Maybe the previous fourth wave of 3, which is right here around 119.92. That'd be the area I'd look for, because the euro is definitely topped, intermediate term and maybe longer term. So I wouldn't be looking for bullish trades here, although this could be quite bullish up into this area, especially if it rallies up and pulls down to a lower low. It might be headed ultimately for this 120 area. All right, where's oil? So we got oil, crude light. Oil continues to sell off. Looks a lot like it looks a lot like the euro, actually. Did a strong sell-off. This looks like a wave 5, so we should see some rally in oil. Maybe oil pulls down to this pivot here around $62 and then rallies. But certainly I wouldn't be short oil right here. I think I'd be waiting for a better place to get short. Um, you can do really all these indices could be evaluated pretty much the same way. I think something has happened here that's caused oil to turn, the market to turn, the euro, the dollar to turn. Everything's kind of turning right in this this week of 522, 521, somewhere around in there. So, I'd be looking. The bounces would be. I'd be looking to get out of these trades if you're waiting for a bounce. U.S. dollar CAD. Again, it's trading in the direction of the U.S. dollar, so it may go a little higher here, but then we should have a fairly good sell-off, maybe back as low as this 125 area, kind of off of this pivot right here. So keep an eye out for that. Gold has broken this trend line, which is odd because this trend line goes back all the way to January, really, and it sliced through it like a hot knife through butter. So I've said here for the last several weeks that gold and silver to me are a little bit tricky and hard to see. So one of the guys I learned under said, if you can't see it, you can't trade it. So I can't see it, so I'm not trading gold, although I hold physical silver for the time being. So like I said, I hold physical silver for the time being, and have since 2015 or so. So, and if you get again, let's look at the big picture real quick. I'm on a daily chart, but let's go to a weekly. The big picture is, gold should pull back and then rally, maybe. But ultimately, I'm looking for gold and silver to pull back to way low, okay? And this would probably be toward the end of wherever the bear market lows are for the market. So this might coincide with a market sell-off of multiple years, three and a half years, something like that. So, and like I've said before, if gold is available, gold and silver are available, I don't want to say you'd be foolish, but let me say you'd probably be foolish if you didn't try to snap some up here, if it's available. And I've talked about why it might not be. There's potentially more gold contracts had been created than actually gold bullion exists in the world, and therefore the market might have gotten ahead of itself. The futures market might have gotten ahead of itself relative to physical gold and silver. So you can't really count on making sure there's, you can't say, oh, for sure I'm going to go buy all the gold coins I can buy here. I mean, two things might be the case at this point, let's say in 2023. First of all, there might not be any gold or silver. The government's confiscated it, or who knows what, okay? But the other scenario could be the commissions are so high that, you have to be willing to pay 15, 20, 30, 40% commission on whatever gold or silver you want to buy. So that's unreasonable, obviously. Normally, you might expect to pay, maybe 2% or something like that. So anyway, that's kind of gold and silver. I'm trying to think of what else I want to look at here. That's really about it. I mean, the NASDAQ, we'll put the NASDAQ on. As you can see, the NASDAQ made new highs, but this looks like maybe a 5-way move is over, like 1, 2, 3, 4, 5, and then 4, 5. In other words, this might be the end of 3 here. So 1, 2, and then this is all 3 all the way to here, and then 4, and then 5. So if that's the case, what do we know about the market, where it tends to go to after 5 waves? Well, it tends to go to the 4th wave, the extreme of the 4th wave low. So somewhere down here around 62.54. And it could go lower than that. I mean, if it breaks below here somewhere, if it breaks below 57, well, then we're going all the way back to the 2016 lows and pretty quickly. So one of the things I want to show you, I've been bringing some of this Elliott wave stuff that I've been reading into these videos, and the reason I do it is just because you just can't find this kind of information anywhere else, and so I want to call your attention to it. So the first thing I want to show you right here is that stock market valuations based on S&P companies' book values and dividends. So this is 1927 to January 2018. And what I want to show you, he's kind of got this whole solar system thing going, where you got Mercury, Venus, Earth, Mars, Jupiter, Saturn, Uranus, Neptune, and Pluto's out here. So what he's saying is that most of the time the valuations are in this range around Earth, okay, right in this area, which is about 1 to 1.5 book value to the company stock. So stock to book value, or however that's measured, I'm not sure exactly. And what he wants to show you is back in March of 2000. Hold on a second. In March of 2000, right up here, 1999, we were out here where Pluto is. And of course, we had a big bear market in 1999 to 2000, 2003, and it brought us all the way back down to Uranus. And then that was it. It rallied up. Well, maybe it went a little lower than that, but basically what I want you to notice here is 2007 and 2008 are all right here too. So 2009. So, and then that was the biggest bull market, or the biggest bear market since the Great Depression. So come 2009, 2010, look where we still are. 2012, we're still at Saturn. We haven't even retraced. Here's 2008 right here. So the 2008 sell-off took us all the way back down here to below Jupiter. But here we are in 2017 or whatever, and we're already back up here around Neptune. So we didn't have much of a sell-off. And so what Proctor's saying is, this is the normal range. We're likely to go all the way back into this area, which means stocks are going to be cheaper. So just something to call your attention to. The other thing to call your attention to is this graph right here. This is an idealized Elliott wave pattern for the grand supercycle top. And I just want to read here. This is, see where it says you are here, pointing to this B wave, I think. And this is what it says. It says 36 years ago, in November 1982, Elliott wave theorists published a schematic of the Elliott wave form and placed an arrow labeled "You are here" on the chart. I showed this picture reproduced below as figure 4 to indicate where the Dow was with respect to its low in 1982. Now, the reason I bring that up is because he's reproduced it again, but he's gone all the way to the start of this move. So remember we talked about these moves coming in 5 waves, right? So here we are right here. So I'm going to highlight that right there. So wave 1 was started in 1784 to 1835. Then you had a wave 2, and then you had wave 3, which culminated in the stock market peak around the stock market crash. And then we had a 90%. Again, this isn't to scale, certainly not log scale or anything, but this right here was the Great Depression. And then this short little area right here is the run up since the Great Depression. So most people haven't lived through this or this. So all they really know is this big up move, which actually extended quite a bit. And then I want you to look at something here. I want you to pay close attention to this. In the idealized form, look where we are right now. This is the wave 2 that we're at right now, right there. So I want you to see how low this goes. And he's only drawing wave A here, but look where it goes. to the 1932 wave 4 low. That's just tremendous. I mean, can you imagine if this market sold off all the way back here to, whatever the value of the market was right here? Now, I don't know if it's going to go that low. I mean, nobody really does. Again, this is an idealized pattern, but it shows you just how big this bear market can be and how devastating it's going to be to investors, including middle-class investors that have 401ks. So I've been talking about this for a while. Of course, it's taking a while for this to kind of run up, roll over, and turn. But the consequences of this, I mean, I could have been talking about it for 5 years, and I think it's still important to talk about because consequences are so grave. I mean, you're talking about losing maybe 95% of whatever you have in the market. So if you have $100,000, that means at the end of all this, you're going to have 5. Well, that's pretty devastating to your retirement. So I don't want anybody to have to experience that. And a big part of what we're trying to do here is to, protect you from that. Because the people in the news, the people on TV are not going to protect you. They don't care about you. Trust me, they don't care about you, okay? So I just think it's important to show how big the ending of this bull market actually is and how devastating it can be. So with that happy note, that is the end of the Middle Class Investor this week. I appreciate you guys coming in. Share this information with your friends and family. Please don't let people you love and care about lose a lot of money and lose everything they have. I know it's a fine line because it's maybe none of your business, but try to introduce these concepts. Now, again, the pushback you're going to get is nobody can predict the market, blah, blah, blah. And we're not trying to predict the market. We're just giving context, okay? We're saying this is the trend of the last how many ever years, and we're here, and here's what normally happens after 5-wave move. That's really all we're saying here, okay? So don't get too hung up on the actual words or who said them and things like that, okay? All right, everybody, thanks for coming in this week. We'll talk to you next week. Take care. Have a great week. And happy Father's Day to all the fathers out there. Take care. Bye.